$70,000. That's what this $600,000 inheritance was about to cost in taxes alone. And the man receiving it hadn't done a single thing wrong. That's the trap. And it catches most people before they ever know to look for it. This isn't about billionaires or trust funds. It's about what happens when real people receive life-changing money at the worst possible time, after a loss, and make the wrong move before they know the rules. More Americans are inheriting money right now than at any point in history. The boomer generation is transferring an estimated $68 trillion in wealth over the next 2 decades. But the rules around inherited money, especially inherited retirement accounts, changed dramatically in 2019. And the people who don't know about those changes are quietly handing the IRS tens of thousands of dollars they didn't have to. This is one of those stories, and the ending depends entirely on whether you know what this man didn't yet. Let's start with what was left behind. A 72-year-old man in California lost his brother. The brother had a will. It said, "Here is my house, my car, my bank accounts, and my retirement accounts, about $600,000 in total." But the will also included a 2-page list of gifts and charities the brother wanted funded, around $450,000 worth. That leaves the heir with a problem. He inherited $600,000, but the moral and potentially legal obligation is to give away 75 cents of every dollar. His first instinct, like most people's, is simple. Take everything, pay whatever taxes apply, then write the checks. That's the obvious path. It's also the expensive one. Here's why. The house, valued at around $400,000, actually carries a hidden advantage. When you inherit property in the United States, your cost basis resets to the market value on the day the original owner died. It's called the stepped-up basis. If the brother bought that house in 1990 for $80,000, that $320,000 in appreciation, gone from the IRS's perspective. Sell immediately, owe zero capital gains. The bank accounts are clean, too. Inherited cash is an income. California taxes almost everything, but it has no inheritance tax. Those accounts transfer untouched. But here's where it gets worse. The retirement accounts are different, completely different. For decades, inheriting an IRA came with a strategy called the stretch IRA. You could take small distributions over your entire lifetime, spreading the tax hit across 30 or 40 years. That strategy no longer exists. In 2019, Congress passed the Secure Act, and it changed the rules for almost everyone. Under the new law, if you inherit a retirement account from anyone other than a spouse, you must drain that account within 10 years. Every dollar that comes out is taxed as ordinary income. This man is 72. He's already taking distributions from his own accounts. He's already drawing Social Security. His taxable income is not zero. Now layer $200,000 in inherited IRA distributions on top of that over the next decade, and depending on how he structures it, he could easily hit the 22 or 24% federal bracket on a significant portion of those withdrawals. California adds another 3% on $150,000 in IRA distributions earmarked for charity. That's potentially $50,000 to $70,000 in taxes paid before a single donation clears. And here's the thing that should make you stop for a moment. Almost none of that was necessary. At 72, this man qualifies for something called a Qualified Charitable Distribution, a QCD. It's one of the most underused tax strategies in existence, and it was designed specifically for situations like this. Here's how it works. Instead of pulling money out of the IRA, paying income tax, and then writing a check to charity, you instruct your IRA custodian to send the money directly to the qualifying organization. The distribution never touches your hands. It counts toward your required minimum distribution for the year, and it is entirely excluded from your taxable income. The limit is $105,000 per year. If the inherited IRAs hold $150,000 earmarked for charity, he can satisfy that obligation over 2 years with zero federal or state income tax on those dollars. That's not a loophole. That's the law, written specifically for this purpose. Most people find out about it after they've already paid the tax. But that's not the only trap. There's a sequencing problem that costs people tens of thousands of dollars in situations like this, and it's almost never taught. When you have a mix of assets, cash, appreciated property, and retirement accounts, and you need to make charitable gifts. The order you donate in determines how much you lose to taxes. You donate the retirement account money first, via QCDs, because it would be fully taxed on withdrawal otherwise. You donate appreciated assets, the house or stock, next, because the charity receives full value and you get a full deduction with no capital gains. You keep cash for personal expenses because cash carries no embedded tax liability. Flip that order and you're paying taxes that were never required. One more tool worth knowing about: a donor-advised fund. You can contribute the house or the sale proceeds into a DAF. Take the full charitable deduction in the year you contribute, and then issue grants to specific charities on your own schedule over time. The deduction is immediate. The distributions are flexible, and appreciated property enters at full market value with no capital gains on the way in. For someone managing $450,000 in promised charitable gifts across a list of organizations, a DAF turns a logistical nightmare into a tax-efficient process you control. None of this is complicated in hindsight. All of it is invisible if you don't know to look. So what does this story actually teach us? First, the rules changed in 2019. The Secure Act killed the stretch IRA strategy for most non-spouse beneficiaries. The 10-year rule is now the default. If you have a retirement account or expect to inherit one, this affects your planning today, not after someone dies. Second, qualified charitable distributions are one of the most powerful and underused tools available to anyone over 70 and a half. If charity is part of your estate plan, routing retirement account money directly to those organizations can eliminate the income tax entirely. Most people who would benefit from this have never heard the phrase. Third, sequence is strategy. Donate retirement account dollars via QCDs first. Donate appreciated assets second. Keep cash last. The order in which you give determines how much you keep. The man in this story hadn't made a mistake yet. He asked the right question at the right time. That's the entire ballgame. The difference between walking away with a meaningful inheritance intact versus handing 5 figures to the IRS isn't intelligence. It's knowing which questions to ask and asking them early enough to matter. If today's breakdown made you realize you're not entirely clear on what happens to your own retirement accounts when you're gone, or what you'd owe if you inherited someone else's, it might be worth taking a closer look at how your money is actually structured. Platforms like Webull have made it easier to start building a portfolio with some intentionality behind it. Webull is offering 90 days of commission-free trading right now. The link is below. Robinhood will give you a free stock just for signing up. Neither one is a financial plan, but knowing what you have is always step one. Now I want to hear from you. Did you know about the 10-year rule on inherited IRAs before today? Drop your answer below, because I genuinely want to know how many people are walking into this without realizing it. Save this video the next time someone in your family inherits a retirement account. This could be the most useful conversation you share with them.